Hello, students. How are you? Are you ready to attend today's lesson? Thank you. Today's lesson is about preparing and processing financial documents. This is Unit 2 of your course. Before discussing this unit, let me revise once again the key activities of accounting process that you have discussed in the previous classes. Here, the key activities of accounting process include three main activities. The first one is identification of economic events, what we call business transactions of the business organization. The second one is a recording of economic events, what we call business transactions of the business organization. And the third one is communicating with the users of accounting information. These are the key activities of accounting process that an accountant must understand these activities. Here, identification of economic events means in the business organization there are so many types of events took place. Among those many events, as an accountant, you must identify the economic events from the non-economic events. Therefore, to identify those economic events, you must ask the question, is this transaction, is this economic event affect the financial position of the business organization? This is a question that you must ask in order to identify the economic events from the another type of events. Therefore, if the answer is yes, that is an economic event. And if the answer is no, that is not an economic event. Therefore, the economic events must be included in the accounting system. Non-economic events are not included in the accounting system. Therefore, that is identification of economic events from non-economic events of the business organization. Then the second, recording, is the main activity or the key activities of accounting process. Before recording these economic events and the journals or account books of the business organization, analysis is very important. That identified economic events must be analyzed. Here, analysis means understanding the effects of the economic event on the basic account equation. Here is the basic account equation. Assets is equals to liabilities plus owner's equities. This is a short form of the basic account equation. It can be also expanded. In order to expand, you have to add all assets. Asset stands for all assets that are the current assets plus the fixed assets plus the intangible assets. Therefore, these three types of assets are together total assets. The totals of these three. Here, current asset means the assets that can be converted into cash within 1 year are known as current assets. Example, cash. Cash here means cash stands for cash at bank, cash in safe, and the cash in foreign exchange. All are cash. Cash is current asset. Another one is account receivable. Accounts receivable, those can be collected within 1 year. Collected within 1 year are known as account receivables. They are also current assets. Inventory, short-term investments, these are current assets. And some others also may be included. Fixed assets, or what we call long-term assets, those cannot be converted into cash form within 1 year, are known as long-term assets. Examples of long-term assets are plant, machinery, building, office equipment, are some examples of fixed asset or long-term assets. Another one is intangible assets. Intangible assets are assets that cannot be seen with your eye, or you cannot touch them, are known as intangible assets. The examples of intangible assets are patent rights, copyright, goodwill, are some examples of intangible assets. Therefore, here assets stands for these current assets, fixed asset, and intangible assets is equals to liabilities. Here liability stands for also current liabilities plus long-term liabilities, and equities also stand for increases of equities and decrease of equities. Here increases of equity are investment by the owner of the business organization. Maybe investment may take place. This is increases in owner's equity. Revenues or incomes from ordinary activity as well as non-ordinary activity are also increases of owner's equity. There are some also decreases of owner's equity. Examples of decreases: withdrawal by the owner for the personal use. Sometimes the owner withdraws some amounts of money from the business, therefore that is the withdrawal transaction, and that withdrawal decreases the owner's equity. Another one is expenses. Expenses decreases the owner's equity. Therefore, in expanded form of accounting equation includes here assets for all assets, that current asset plus fixed asset plus intangible asset is equals to liabilities. Here liability stands for current term liabilities and long term liabilities plus owner's equities. Owner's equity here revenues, investments are some increases on owner's equities minus withdrawals and minus expenses. These are owner's equity. Therefore, this is the long or expanded form of account equation. Therefore, analysis here means understanding the effects of economic events, whether they change the account equation or account equation elements. That means whether they change the financial position of the business organization or not. That is the analysis. After analyzing, you will record it. That recording is the main or key activity of the accounting process. Therefore, the second step take place, that is recording. If it is an economic event, that is recorded in the source documents as well as journals. Otherwise, if it is not an economic event, it is not just included in the business records or financial systems or accounting systems. Okay. Before recording, these economic events analyzed, then they must be captured by the source documents. These source documents are used just as an evidence to record in accounting system, to record in accounting books, that's in the journals. There are different types of journals, special journal as well as general journal. Therefore, recording is the second step. Here, in order to record, you have to understand the source documents, financial documents here. Unit 2 is presents about preparing and processing financial documents. Therefore, the objective of this unit, let me present you the objective of this unit. Objective means as the end of discussion of the unit, that is the preparing and processing financial documents, you will be able to explain the meaning and the types of source documents in accounting. This is the first objective. Another objective is at the end of the discussion you will be able to understand the importance of source documents in accounting. Then you will be able to prepare the source document to process invoice and receipts. These are the objectives of this unit. Here, preparing and processing financial documents is the main topic of the unit. Therefore, in order to understand or in order to achieve the mentioned objectives, the following subtopics are included in this topic. Subtopics. Sources of financial documents in accounting is the first subtopic, and preparing the source documents in accounting. How can we prepare source document in accounting? These are the main subtopics of the unit. Then there is a unit summary also. Unit summary that summarizes these topics. Let us start from the meaning and types of source documents. Meaning. Meaning here means how do we explain the source document? Here source documents are the original documents. They are the original documents that provide the evidence of transactions, business transactions, yes. They provide the evidence of the business transactions that have taken place within a business organization. If there is no evidence for the business transaction or for the economic event, that event cannot be included or recorded in the journal, not to be included in the accounting system. Therefore, they are the evidence of the business transaction that have taken place within a business organization. They are the foundation of the accounting process. Foundation means the beginning or the starting point for the accounting process. If there is no source document, financial document, that means source document, therefore we cannot record in the journal. Therefore, these documents are the foundation of the accounting process. These source documents capture the key information about a transaction, such as the names of the parties involved in the business transaction, the name of the parties. In the business transaction, you know that at least two parties must be involved. Two parties means whether the buyer or the seller or the producer or the consumer, are two parties must be involved. Another criteria to be considered as business transaction, these two parties must be exchanging the valuable objects. The seller must give the valuable object to the buyer, and the buyer must give the valuable object to the seller. They get into obligations to exchange these valuable things together. This is another criteria in order to consider that the business transaction has happened. Another one is it must take place in a specific period of time period. And another one is just must be authorized. This transaction must be authorized, and the stamp must be, the stamp of the business organization must be stamped on the business transaction. Otherwise, we cannot say that is a business transaction. Therefore, these are some of the information that included in the source documents. Therefore, these source documents capture the key information about the transaction, such as the names of the parties involved, amount is very, very important, because amount means, as we spoke on the concepts and the principles of accounting, unitary monetary measurement unit. That means amount is the measurement of the object. Measurement of the object. It is very, very important information. Another, the date, that time period, and the names of the accounts. The names of the accounts are some information, are basic informations of the source documents. Therefore, this source document captures the key information about the transaction, business transaction. Also, they are proving the recorded in financial transactions occurrence. Yes, these financial documents or source documents prove the recorded financial transactions occurrence, that the transaction has occurred. They prove. They are very, very important for auditing procedures also. Auditing procedures. If there is no evidence or source document, auditors don't consider that transaction is happened. Therefore, if you are an auditor, external auditor, just you start your work of auditing by collecting all source documents that evidence of business transactions. Therefore, they are very, very important for auditing procedures. Okay, this source document usually includes the total value of a transaction, the date of the transaction, the brief explanation, and one or multiple authorized signatures. Okay, this is some meaning of the source documents. Let us discuss the types of source documents in accounting. Types. The most commonly used types of source documents here are, for example, purchase order. One type of source document. The buyer sends the purchase order to the seller. Purchase order outlines the list of goods or list of services needed and the time when goods or services should arrive to him or her. Another type of source document is sales invoice. This is the reverse of purchase order. Purchase order considered in the buyers, and the sales invoice considered in the sellers. Therefore, sales invoice is a tool for managing account receivables from the customers. When the seller delivers goods to the buyer, he or she will provide a sales invoice containing all relevant sale details. Therefore, it is a source document. Another source document, purchase invoice. It is also a tool for managing account payables. Account payable means liabilities. The seller will enter this purchase invoice as sales invoice, while the buyer will enter this purchase invoice as a purchase invoice. Another one is debit note. This is another type of source document. It is this source document is evidence of a reduction in purchases and can be useful to support purchase return journal, supporting document for the purchase return journal. This debit note. Sometimes the delivered goods, some of the delivered goods are damaged or broken. Therefore, that damaged or broken goods must be subtracted. Their amounts must be subtracted. Therefore, in order to subtract these their amounts, the damaged goods amounts, debit invoice note is sent to the seller from the purchaser. It can be useful to support purchase return journals. Moreover, in customer books, debit note will reduce what? How much the customer owes to the seller. Okay, another one is the credit note. This is also another source document. This is the evidence of reduced sales, and it supports sales return journal, supporting document to record in sales return journal. In seller's books, the credit note reduces the amount owed by the customer. When the credit note is available for the seller, this is reduces the amount owed by the customer. Another one's check. Check is also another source document. This is a special banknote. This is banknote that represents the cash paid by the customer. Another is revenue receipt. This is used to record the receipts of cash. Which is a proof that the payment is made. Another one's cash register receipts. Cash register receipts are a business paper. They are a business paper that lists the money coming in from customers. Another type of source documents, bank advice. Here, bank advice means it may be credit advice or debit advice. A bank source document that informs an increase or a decrease of bank account of a business organization. Business organization has bank accounts. Therefore, if the bank account of that business organization increased, then credit advice is sent to the business organization. And if the bank account of the business organization is decreased, then the bank sends debit advice to the business organization. Another one, deposit slips. Deposit slip here. When one receives check or cash from his or her customer, the seller will take it to the bank and present it to the banker. Then the bank increases seller's bank account. Therefore, that is by these deposit slips are just the source documents in order to increase bank account. Bank statements, another source financial document. This is also financial document. This is a summary of financial transactions that occurred at a certain institution during a specific time period. For example, a typical bank statement may show what? Your deposits and withdrawals for a certain month. This bank statement shows the deposits in your bank account and the withdrawals from your account for a certain month. Therefore, this bank statement is always prepared for 1 month. Every month, bank statement is prepared for bank account of the business organization. Also, bill of exchange, also another one's bill of exchange. This is a source document related with what? The foreign trade, international trade. This bill of exchange. Buyers and the sellers, for example, may get into international trade. Therefore, in the form of international trade, such type of bill of exchange are used as a source document. It is a conditional order in writing addressed by one person to another and signed by the person giving it. It also requires what? The person to whom it is addressed to pay or demand. Another source document or financial document is payroll report. The payroll report, this refers to the list of employees of a business organization and the amount of compensation or the amount of payment due to each of the employees. Cancel check, another source document is cancel check. This is a check that has been paid or cleared by the bank. Paid or cleared by the bank are known as cancel check. And the check stubs typically attached to the checkbook and contain details such as the check number, date on which that check was prepared, the payee, amount, how much amount, and the purpose of the payment. These information are included in the check stubs. Okay, employee time card, another source document, another financial document. Employee time card. This is a method for recording and tracking the amount of an employee's time. How much time an employee worked in the business organization. Yes, on each job. Therefore, employee time card is another source document or financial document, what we call. The board minutes or the minutes of meetings. Here, the secretary of the board usually takes minutes during a meeting. Therefore, this meeting is very, very important. Therefore, these board minutes or minutes of meetings are another documents, financial documents used. Okay, goods dispatched note. Goods dispatched note. This is a document of the company that lists what? The goods sent. The goods sent out to what? A customer. The goods sent out to a customer. Without a doubt, the company will keep one record of goods dispatched notes. This shows the goods sent out to a customer. This goods dispatch note. Another one, goods issue note. Goods issue note. This goods issue note is a physical record. This is a physical record of the movement of goods or materials from the warehouse or the store to the production department. It's within one organization, from one department to the production department, goods store department, therefore, store department or warehouse. Another is production department, therefore goods from the warehouse taken to the production department. Therefore, the physical record will take place. That shows on a goods issue note. Stock takes records. Another one is stock takes record. This is called the stock counting. The stock counting. It takes place when you manually check and record all the inventory that your business currently has on hand. Stock take record. That is inventory note. Inventory is taken, then this inventory taken will be shown on stock takes records. Another one is stock record by itself. Stock record. This is another important source document in accounting that provides information about the inventory or the stock levels of a business. These records help the businesses track the quantity, the value, and the movement of their inventory, which is important for managing costs, fulfilling orders, and making informed business decisions. Another document is goods received note. Goods received note. This is source document that shows the goods that a business has received from a supplier. From the supplier, the received goods note. From the suppliers, goods are delivered to the business organization. Therefore, the received goods shown on goods received note. Another one is remittance advice. Remittance advice. This source document can confirm the amount paid, and it shows discrepancies, that means differences, that can easily be investigated. Another one is insurance endorsement certificates. Another source document, financial document. Insurance endorsement certificates. This is where one party will add the other party as an additional insured on their commercial liability insurance policy. If another insured party is added, then insurance endorsement certificate will be given. This is used as to record additional party, the additional party, that additional insured party in the insurance companies. Another one is point of sales summaries. Point of sales summaries. This can be used to record a number of sales at a cash register. Another one is memorandum. This memorandum, or what we call memo, is a written document businesses use to communicate an announcement, policy changes, price increases, or notification to take an action, such as attend a meeting or change a current production procedure. Therefore, memo is another financial document. Another document is computer generated receipts. Computer generated receipts. This is the kind of receipts to be generated by the computer. Just computer generated receipts. Another one is lease agreement or rental agreement. This is also another type of financial document. Here, lease contracts are formed. Lease contracts are formal documents that identify the lessor, lessee, what is being leased, whether it is an asset or a property. Another one is sales tax returns. Sales tax returns. This is another source document or financial document. This is the taxpayer's document, the taxpayer's document of declaration. This will enable the taxpayer to furnish the transaction details during a tax period and deposits his sales tax liability. Another one is cash register tape. Cash register tape. This provides a detailed record of transactions processed through a cash register or point of sale system. Adjustment notes. Adjustment notes. These are source documents issued to customers due to damaged, returned, or undelivered goods. Adjustment notes. Which is related with debit notes. Debit notes or credit notes. Yes. Employee pay advice. Another one's employee pay advice. This is a source document that can help to provide a written evidence concerning the employee income. Payroll advice report. His payroll advice report. This source document helps the small businesses understand payroll costs, the payroll costs, and summarize the payroll data. Evidence of sale or disposal of assets. This is also another source document. Evidence of sale or disposal of assets. This is a source document evidences the removal of a long-term asset from the company's accounting record to remove. Otherwise, it is not removed. If there is no evidence of sale or disposal of asset, no can consider it is removed from the accounting records. Okay, let us now discuss the importance of the source documents in accounting. Why these above mentioned source documents are important. Why above mentioned financial documents, or what we call source documents, are very, very important. Why they are important? One reason is for accuracy. For accuracy. Here accuracy. Source documents provide the necessary information. They provide necessary information to record a transaction accurately in the accounting system, ensuring that financial statements are prepared correctly. Just they ensure financial statements to be prepared correctly. Therefore, accuracy, for accuracy reason, they are very important. Another one, they are evidence. For example, they are an evidence. Source documents serve as evidence of transactions. Evidence of transactions. And they help to prevent fraud and errors. These source documents prevent fraud and errors in the accounting records. Another reason is compliance. They are for the compliance. Compliance here means source documents are essential for the compliance with tax laws and regulations. Laws and regulations. Compliance of the laws and regulations, as they provide proof of income and expenses. If income is there and if the expense is incurred, if income is earned, if expense is incurred, these source documents show as an evidence. Therefore, compliance is one reason why these source documents are very important. Another reason is just for audit trail. Audit trail. They are audit trail. For audit trail, source documents create an audit trail. Audit trail means paper. For audit paper that can be used to track transactions and verify the accuracy of the financial reports. These are reasons why these financial documents are very important for the business organizations. Okay, let us discuss the preparing the source documents in accounting. Let us discuss the preparing source documents in accounting. Overview here. In accounting, preparing source documents is gathering all the important papers. Gathering all the important papers that show what a business has been doing, what a business organization has been doing. Yes. The papers here include what? Receipts. A receipt of resources, just a resource, cash, and a receipt of goods, services, just invoices that help keep track of money coming in and going out. It is like putting together a puzzle to see the whole picture of a company's finances. By making sure these documents or papers are organized and correct, businesses can create the clear and honest reports of their money activities. Okay, let us talk about the key steps of preparation. The key steps of preparation and the processing of these financial documents. The first step is gathering the financial data, financial sources. Data means financial sources. Gathering the financial data means gather all the relevant financial data from various sources, different sources within the organization. This may include what? The invoices must be gathered, the receipts must be gathered, bank statements must be gathered, payroll records must be gathered, and other financial transactions must be gathered. Therefore, gathering financial data is the first step to prepare source documents. Second step is organizing the financial data. This gathered data must be organized. The collected financial data in the first step needs to be organized systematically. What does it mean? This means is sorting the data into categories, just such as income group, expenses group, assets group, liabilities group, etc. to facilitate accurate recording and analysis. This is organizing financial data. The third step, recording these transactions, just recording. After organizing, first gathered, then organized, then recording transactions. This process involves the entering transaction details such as date, amount, description, and accounts affected by the transaction in a journal or accounting software. This is the second key activity of account process, as I told you before at the beginning. The among the three key activities of accounting process, here recording transaction is the second key activity of account process. Therefore, after gathering, after organizing, then the financial documents you have to record. Recording is the key activities of accounting process. Amount, description, date, and accounts affected by the transaction in a journal or accounting software. Just recording maybe take place manually as well as in accounting software or on financial books. Just then the fourth step is reconciling the accounts. Reconciling accounts. This involves comparing the internal records with external statements, example bank statements, to identify any differences or discrepancies that need to be resolved. This is to ensure that all financial transactions are accurately recorded. Reconciling means just as I told you, adjustment, adjusting. Then preparing financial statements. Also preparing financial statements is another step, fifth step. Once all transactions are recorded in a journal, that may be in a special journal or in a general journal, entries are then posted from the journal to the account in the ledger. Ledger may include general ledger and subsidiary ledgers also. General ledger and subsidiary ledgers. Then after that, summarize. After summarization, preparation, adjustment, correcting errors or correcting entries, adjusting entries are also recorded in the journal also. Then everything completed, financial statements are prepared. From the adjusted material balance, financial statements are prepared. Once all transactions are recorded and reconciled, financial statements can be prepared. Financial statements provide an overview of what? The organization's financial performance and the position, such as financial position statement, what we call the balance sheet, income statement, what we call profit or loss statement, owner's equity statement, cash flow statement are known as financial statements. Another step is reviewing and analyzing the financial statements. Yes, reviewing and analyzing financial statements. This is to assess what? The financial healthiness of the organization accurately. This analysis helps stakeholders make informed decisions. This will be learned in degree levels as well as master's levels analysis, but it is because it is a step, you have to just discuss this. Auditing financial documents. Auditing financial documents. Here, financial documents are audited by the auditors, by the external auditors. Always, financial documents are audited by the external auditors, that certified public accountants. It is a crucial step in verifying the accuracy and reliability of the financial documents. An independent auditor examines the financial records to ensure the compliance with accounting standards and regulations. These are very important when you attend the degree level courses and master's level courses. You learn this at this level, at the grade 11 level. They may not very important topic, but for understanding matters, you learn this. Auditing financial documents is another step. Filing tax returns. File tax returns accurately and timely. This involves calculating taxable income, because After calculating the taxable income, tax will be calculated. After from the taxable income, tax will be calculated from the taxable income. And deductions, credits, and other relevant tax information required by tax authorities. Okay, maintaining the documentation then. Maintaining the documentation, ninth step. It is essential to maintain proper documentation of all financial transactions and records for future reference, or for audit purposes. This facilitates transparency and accountability in financial reporting. All documents must be documented. The last is implementing internal controls then. Implementing the internal controls. This internal control safeguards assets, prevents fraud, errors, and ensure compliance with laws and regulations. It also reduces the risks associated with financial document preparation and processing. Okay, these are the last topic. Let me revise you summary of the topics here. In the unit summary, we revise learning outcomes of this unit. As I told you before, the learning outcomes, the first outcome explaining the meaning and the type of source documents in accounting. Yes. Explaining the meaning and the type of source documents. Therefore, source documents are the original records that provide evidence of a business transaction. They serve as proof that a financial transaction has occurred. Types of source documents used in accounting includes the invoices, receipts, bank statements, purchase orders, sales orders, checks, and the contracts, so on. Each type of source document serves as a specific purpose. They all each type of source document have a specific purpose. The second outcome of the topic is the understanding the importance of source documents in accounting. Understanding the importance of source documents in accounting. First, they provide evidence that a transaction has taken place. They are evidence, and they help to ensure the accuracy and the reliability of financial records. Without a source document, recording a transaction will lead to potential fraud and errors. Without a source document, recording a transaction in a journal lead to potential fraud and the errors. Therefore, they are very important. Secondly, source documents serve as a reference. They are a reference point for the auditing purpose. They are allowing the external parties to verify the authenticity and the validity of financial transactions. And the third outcome of this topic, preparing source documents for processing invoices and receipts. Preparing source documents for processing invoices and receipts. To prepare source documents for processing invoices and receipts ensures the accuracy and the completeness of transactions, such as the date, amount, description of goods or services provided, the payment terms, and the applicable taxes or discounts and the signatures of authorized persons. All these informations are very, very important. Therefore, in order to prepare the source documents, you have to process invoices and receipts. These invoices and receipts capture these informations, what I told you here. The date of the transaction, the amount of the transaction, short description of goods or services provided, the payment terms. Within the payment term means in cash or in credit, or if it is in credit, how can it be paid, and applicable taxes, discounts, signature of authorized persons are informations very important, must be included in the invoices and receipts. This information, properly prepared source documents facilitate the smooth processing of invoices and receipts by providing all necessary details. Okay, these are the last topic, or the last discussion for this unit. Very good. Thank you.